right, Lynn Sampson, welcome to Bitcoin Capital.
Thanks for having me.
Thanks for having me.
All right, before we get going, I'm going to read an ad for Liquid. All right, so I hope this comes off naturally. Before we dive into today's episode, I want to tell you about an incredible event that's just around the corner. If you're an investor or simply passionate about the future of finance, mark your calendars for October 24th. That's Plan B in Lugano. So the Liquid Network, in collaboration with Plan B Forum, is hosting Investor Day in beautiful Lugano, Switzerland. This is an event you don't want to miss. The focus will be on capital markets, delving into the platforms and services available, and showcasing the infrastructure that traditional financial players can leverage. Participants include high net worth individuals, bankers, traditional finance professionals who are interested in either utilizing the products offered through these platforms or just collaborating with Liquid to build on infrastructure provided. The event is invite only, but if you head over to the URL that should be scrolling across below, you can apply for a spot today. All right, with that out of the way, we can jump into the episode. So today we are very excited to have with us two of Bitcoin's best known thought leaders. First of all, we have Samson Mow, founder of Gen3, former CTO of BTC China, former CSO of Blockstream, renowned toxic maximalist, and Lord of Hats. So I brought two hats out from my collection in honor of Samson today. And we're also very happy to have an opportunity to speak with Lyn Alden, author of Broken Money, a general partner at Ego Death Capital, and one of the most articulate Bitcoin macro voices in the space. So again, welcome Samson and Lyn to Bitcoin Capital.
Happy to talk.
Thanks. Great introduction. Great. I'm wearing my Bitfinex hat.
I noticed that. I did notice that. Very good. Thank you. All right, Lyn, maybe to start with you. You published your book second half of last year, Broken Money, and you also have a really good video summary of it that I noticed on Twitter, a 30-minute video. Maybe to start off with a very high-level question, how is money broken and how does Bitcoin help?
So there's a lot of reasons why it's broken, but I think the biggest one has to do with speed. So one of the key things that I focus on in the book is that you can kind of segment the world into a couple different eras. There was pre-telegraph. So before the telegraph, there were various ways to abstract money and make it move around easier, basically various paper instruments on top of gold, that kind of thing. But they inherently all move at the speed of matter. You can't, send that around any faster than people can move around the world. But starting with the telegraph, and specifically the adoption of the telegraph in the second half of the 1800s, we had a point where information could now go at the speed of light, but physical settlement was still stuck at that much slower speed. And so by opening that speed gap up, between if you can move information, you can move transactions, but you still can't do settlements. And so that huge transaction and settlement speed gap kind of put us into this next era where we had this kind of massive speed mismatch. It was the first time where monies didn't just win by being harder, they also had to be faster. And in that world where no settlement was fast enough, the only thing fast enough was an IOU to keep up in the telecommunication connected world. And so that's where vast amounts of debt came from. I mean, it wasn't the origination of debt, but the sheer amount of debt, a debt-based economy, literally the reserve asset of the world, the treasury security is debt. That's what kind of facilitated so much debt. And the way that Bitcoin can address this is that it's basically the invention of fast settlement, the ability to settle final value in an irreversible, non-credit based way, roughly as fast as the speed of light. And so for the first time, we've closed that transaction and settlement speed gap. And so now we're seeing that adopt, we're seeing that grow. And if that does reach a certain scale, that can address, I believe, a lot of the kind of these developments over the past century and a half.
So playing devil's advocate, does it have to be Bitcoin or could it be other forms of commodity-based money? Could you have tokenized gold, for example, which maybe measures up better to Bitcoin in terms of portability and fractionalization, or is that still credit on the gold?
Well, that's still credit. The way that they're run now is they're not fractional reserved, but that's still credit. It's a chain of legal custody rather than actually owning the underlying. And so, for example, if you're using that as a global settlement asset, there's still layers of trust involved. That doesn't mean that they're not useful. I mean, that's still a useful product. But basically, it's not fundamentally the same as the bearer asset itself moving at that speed. Now, in theory, I mean, could have Bitcoin been slightly different? Could you have made 7-minute blocks, or could you have made 42 million coins? There's different things that the first Bitcoin could have looked like, but basically, whatever solves the problem and bootstraps and reaches network effect and is designed in such a way to be simple, robust, secured, and stays decentralized, is effectively the kind of, I would say, the structural solution for the problem.
That makes sense. And following up on that idea of commodity-based money, I wanted to ask you, because you kind of have a real-world example with USDT, which is tokenized US dollar, and XAUT, which is tokenized gold. So you've got the credit-based money and then the commodity-based money. And then, interestingly, I think it's, I understand why banks and policymakers prefer the credit-based money, but it's not, obvious why users would prefer it. And in this real-world example, especially in places like, emerging markets or places with really high currency volatility or inflation, everybody prefers USDT. They don't seem to prefer the commodity-based, the gold-backed money. Do you have any thoughts on why that is?
So my first thought is I've observed that, and I found that very interesting, because you would think that the gold product would have perhaps larger demand than it does. Sometimes when you see gold enthusiasts kind of not particularly like Bitcoin, not like this industry, they'll say, why can't we just tokenize gold? And it's like, well, we have it's out there. It's a product on the market. It doesn't have a ton of adoption. I've thought about different reasons as why that might be the case. My best estimate is that a lot of it has to do with unit of account bias. The basis is not just medium of exchange and store of value. There's also unit of account bias. So anyone who has dollar liabilities, to the extent that they want dollar assets to correspond to them. They don't want that volatility between assets and liabilities. And two, a lot of people around the world think in dollar terms. Americans think in dollar terms, but then in other countries, you generally think in a handful of different currencies. Your local currency, the dollar, maybe some neighboring currencies like the euro. But really, no one's really kind of pricing things in grams of gold, for example. It's not the unit of account bias. So when people have these kind of intermediate term, positions in tokenized assets like dollars, they seem to gravitate toward gold. I've asked, what I spend every month, every summer, I should say, living in Egypt with friends and family there. And one thing I'm always doing is asking people why they're stacking dollars. A lot of them buy dollars on the black market, and they'll literally hold a stack of dollars. And gold's also popular there too, but a lot of them are holding dollars. I'm always kind of like saying, I'm always asking people, how do they make that trade-off between different things? And so I'd be kind of surprised in many cases how many people gravitate toward dollars over gold, even when they do have the choice.
Yeah, that's interesting. One thing I was going to say is there used to be a website, I don't think it's still up, Stablecoins War, and they had a measure for velocity of the different stablecoins. And one thing I noticed was the velocity for Tether was like multiples higher than everything else, which kind of implies that people are actually using it. So I was going to say maybe it's that people are actually using it, and it's the network effect of US dollars, and they're buying things priced in US dollars, and maybe they're not saving it as much as we on the outside kind of think. But what you just said, I guess, is kind of counter to that. Maybe it's a bit of both. I don't know.
Yeah, I think ultimately the gold, basically the gold tokens are kind of like an ETF that's available worldwide instead of just on a specific U.S. exchange, which is a useful thing to be out there. You would think that the market would get bigger than it is now, but I guess ultimately it's between two worlds. On one hand, like you said, the dollars are moving around faster. People price things in dollars; they don't price things in gold. They have liability. Many of them have liabilities in dollars, and so that's kind of the world. That's one side. Another side, if they're thinking long-term store of value, many people that have crossed the chasm into the world of digital assets would rather own Bitcoin than gold, especially at scale.
Yeah.
And so gold's kind of serving a niche. I think it's good that it's out there. The market can choose it. But I guess it's just not hitting liquidity kind of critical mass. It's not appealing to people enough.
Yeah, that's interesting. Samson, shifting over to you. So there's been a lot going on in nation state Bitcoin stuff. So over the last week or so, we've had rumors that Trump is in favor of building a Bitcoin as a strategic reserve asset. And then a couple of weeks before that, we had Germany unloading 50,000 Bitcoin for almost $3 billion. What are your thoughts on those headlines?
Well, I think it was a big mistake for Germany to sell. And I'm working with Joanna to put together a plan for them to buy it back this October. So we'll see what happens there.
At a higher price.
Yeah, well, you get Bitcoin at the price you deserve, right? So it might be higher. Probably will be higher. But I think it was a big mistake for them to sell. I believe they had to sell because it was a seized asset. And legally they had to dispose of that quickly, relatively quickly, and it's debatable if it was on the right time horizon or not. But it is what it is, and I think this is going to be a major point of regret for the German people in the future. And it's not too late for them to buy back. So we'll see what happens, how it plays out. But the Trump thing is really interesting. A lot of people were asking me what I think about that, and Trump is a interesting character. I think he likes to follow through on his promises, at least in some capacity. So I remember in his last presidential campaign, a big part of it was, aside from Make America Great Again, it was build the wall. We're going to build the wall. And they did kind of build a wall. It was not the wall that maybe everyone envisioned that's kind of bisecting the US and Mexico 100%. But there was a wall built, and it was a decent sized wall, and it's still there. So I think as long as he follows through with his promise and he buys some Bitcoin, maybe he's not going to put 1 million Bitcoin into a strategic Bitcoin reserve, but he might put 10,000 or 100,000. And I think that's good enough to really kick off that train of nation state Bitcoin accumulation and strategic Bitcoin reserves. So I think no matter what, something good will come of Trump winning the presidency.
Yeah, and it's bigger than the US too, because I think it's like when you talk to regulators over here in Taiwan or elsewhere in Asia, their first question is like, okay, well, what is the US doing? Okay, what is Japan doing? They don't want to be first movers. They kind of want to see what the US is doing. So I think if the US sets that precedent, then it makes it really, it's just like with the ETFs, it makes it much easier for regulators and policymakers and central bankers and other jurisdictions to kind of follow through and do the same thing. So it could be another big, wave of capital, which is exciting.
Yeah, and we did see that exactly play out for the ETFs, right? The US passed the ETFs first, and then we saw the Hong Kong ETFs pass, and then the Australian ETFs passed. And I know from behind the scenes that the regulators were looking at the US first, so to provide that indication that it's okay. So it'll be the same thing, I think, for the strategic Bitcoin reserves. So El Salvador did start the nation-state Bitcoin adoption game, but no one's really emulated them yet. But I think that's because it's still too small. But the US coming in, no matter at the size of their accumulation, it's going to be a totally different ballgame.
Yeah, I guess El Salvador is kind of a very unique situation where a lot of things came together at the same time, right? Where you've got a dollarized economy, so they can do that. They can adopt a second currency, I guess. And then you've also got this very, progressive, forward-thinking, young kind of visionary leader who's has a real strong political mandate to do it. I think it's really difficult to do in almost any other place.
Well, the interesting thing is I didn't think it would happen in the US, but recent events with Trump and what he's saying seem to point in the direction that they will do it. So we're going to have a major economy adopt Bitcoin in a very significant way. And I don't think the repercussions are much predicted and understood yet, but I believe it's Omega Candle material.
Yes. What about Canada, Samson? Is Canada going to have a strategic Bitcoin reserve? I know we sold all of our gold in like 2012. Are we going to make up with it by buying Bitcoin, you think?
Well, it depends. So a lot of the work we do at Jan3 is working with governments and politicians around the world. And a lot of our effort is really just biding our time and waiting. So there were a few countries in LATAM that seemed promising, and we were at a decent level of discussion and discourse. But then there was a change in the government, and that kind of reset everything back to zero. But it plays the other way too. So in Canada, with the Trudeau government, I think there's a zero possibility that anything meaningful will happen. If they had more gold, they'd sell it, right? And they would get rid of it for whatever reasons they do that. But I think there is hope in Canada with a government formed by Pierre Poilievre. He has been talking about sound money for some time now, and I've met with him before too. So I understand that he has a good grasp of money and what money is and why you want sound money. But I think the Conservative Party is keeping him from talking about Bitcoin until the election is won, because it can be a divisive or an issue that could cost voters. So I think they're keeping quiet on that topic because, unfortunately, he did talk about Bitcoin right before the downturn. If he talked about it now, I think it'd be a different situation. But they're playing their cards very close to their chest. So, yeah, I would say give it a year. That's the next election in Canada, 2025. And then we might see Canada following the US if Trump wins and he follows through with his promise.
Yeah, so there's obviously a lot of things in flux in the world at the moment, and it's perfect kind of macro stuff in terms of writing material, Lynn. I think the consensus view now is that we're kind of at the tail end of this rate hike cycle. What is that your view as well, and what does that mean for the economy, for inflation, and for Bitcoin?
Yes, that's my base case. The market's gone through these cycles where they priced in a bunch of cuts that never happened. Now they're pricing in mild cuts going forward, and I think that's a fairly rational approach. We're kind of, for a while now we saw pretty dislocated markets. So, in the U.S., for example, manufacturing was weak. Obviously, commercial real estate was weak, but a lot of the labor stuff was really strong. A lot of the consumer spending was really strong. And what we've seen in the past couple months is the labor market has softened, and the consumer spending is softened, and so that kind of that final leg that was kind of holding things up particularly strong is weakening a little bit, and so my expectation is we probably have later this year and into early next year probably some rate cuts ahead. And one of the things I point out though is that much like how the U.S. economy was fairly insensitive to rate hikes, there's a good chance it's going to be fairly insensitive to rate cuts. So basically, the U.S., more than most other countries, locked in a lot of long duration fixed rate mortgage debt, compared to most other countries in the world. And also, our corporations tend to borrow from the bond market more than banks at a higher rate than other countries. And so, our private sector tends to lock in this fixed rate debt wherever possible. It's kind of how our markets are structured. And so, combined with the amount of fiscal deficits that are happening and the fact that the government's debt, ironically, refinances at these higher rates more quickly than the average private sector, we've had a situation where there are some parts of the economy that are very punished by the higher rates, such as commercial real estate or small businesses that are relying on bank loans. But those big chunks of the economy have been fairly resilient to the rate hikes. And if they do trim by a handful of basis points, it doesn't mean that we're going to get any sort of mortgage refinancing wave of any meaningful scale, because not that many people locked in these high mortgage rates. And so I think there's only kind of around the margins would that be helpful to a number of businesses. And so I think this can be fairly uneventful. And I think the bigger story is fiscal. So fiscal dominance, fiscal deficits, any sort of fiscal decisions by Congress and the president. I think all of that in this particular era matters a lot more than central banking does, even though central banking is still a variable.
And do you think the markets will also be? Oh, go ahead, Samson.
I want to go back and hear Lynn's take on the Trump Bitcoin support.
Sure. So, well, it's interesting. One option he has is just to not do what Germany did, which is to say, the United States government has something like 200,000 Bitcoin. So whatever law requires them selling them, override that law, change whatever has to be changed, and say just to hold that amount. And then you have 1% of Bitcoins. That's kind of the low hanging fruit. Or just if they do sell them, just offset that with purchases. It's certainly within his purview to make that change happen should he want to. If they could do it in an amount that is at current prices not particularly meaningful or risky to the U.S. government, should they be concerned around the downside. The a bigger story there is that in Trump's first term, he had a mix of people. Some of them were in favor of dollar devaluation, and some of them were in favor of kind of holding the dollar where it is. And because he had a goal of reducing the trade deficit, and he did the tariffs, and they didn't really do much to actually affect the trade deficit. It's still there. It's still growing. The second term, the similar voices he's going to have from the dollar devaluation side. There was an interview not that long ago, as it was in like late June, I think it was, with Bloomberg with Trump, and they asked him about the state of the economy, and the first thing he does is go into like relative currency differentials with Japan and China, which is normally not what you'd hear out of a Trump description of the economy. So basically, currency is top of mind for the president, for the vice president, and for his former trade representative. And so I think there's a higher chance in the second term they'd have some more meaningful kind of currency interventions. And one of the methods of currency weakening is reserve accumulation. You can create more of your currency units. Basically, you're doing what MicroStrategy did, except it's the government's currency instead of their equity. They create more currency units and they use it to buy reserve assets. It's something that a lot of trade surplus nations do on a regular basis to prevent their currency from increasing. And with some of these people in the administration, it's not out of the realm of possibility they could include Bitcoin as part of their reserve accumulation if they wanted to go that approach. And I'm not saying it's going to happen, but I think the voices that would point to something like that are probably going to be a little bit stronger in the second term if a second term happens compared to the first term.
There's also rumors that he's going to appoint Larry Fink to the Treasury.
Yeah, we'll see. I mean, I've heard
We'll see.
a couple different rumors now, but yeah, we'll see.
And how does all of that impact inflation? Lynn, what's the view for inflation?
Well, that's the downside. Basically,
Yeah.
the complication right now is that he wants to fix the trade deficit, reshore manufacturing, but also both Trump and the Republican Party, their official position is they want to reduce inflation. But one of the risks, one of the high likelihood risks of dollar devaluation, reshoring, and reserve accumulation is a period of inflation with that. So I generally lean toward ongoing waves of inflation, in the next term, let's call it. And that's kind of my view, regardless of the election outcome. But then obviously certain election outcomes and then certain decisions by who wins can pull that forward, can make it larger. So, but yeah, that's basically that's the whole kind of downside of currency devaluation in the first place is, depending on how someone's looking at the economy, there are issues when you have an artificially strong currency, which is different than sound money. It's kind of like this wonky situation of kind of having a debt-based currency. You can have an artificially strong currency, or you can have an artificially weak currency, and there's different kind of pros and cons that for a particular economy that come with that. And if they do engage in the approach of saying the dollar's too strong, we want to weaken it, we want to have better trade deals, the biggest risk factor for that is inflation.
And I guess that's kind of fundamentally some pain you want to have to go through. It sounds like deglobalization, right? Where you're repatriating manufacturing, you're kind of rolling back some of the globalization that's happened over the last couple of decades and has driven economies like China, also Taiwan. There's no way around that, right? There's pain that I guess you have to go through. And then I guess on the other side, the benefit is that you get higher paying manufacturing jobs that maybe offset some of that pain that people are feeling in terms of inflation.
Yeah, that would be basically a more balanced economy right now, because the dollar and dollar denominated assets like treasuries are at the heart of the system. It means, most currencies trade on kind of trade balance differentials and interest rate differentials. Those are kind of the main components that affect relative currency valuations. The dollar has an extra layer of a monetary premium on top of those variables because so many countries just hold it as the most liquid, reserve asset around. And what that does is that gives an extra boost to American imports and an extra kind of downside to American exports. And so for decades, you had the situation of we run structural trade deficits with the world for a longer period of time and at bigger scale than almost any other country. And then the rest of the world takes their dollar surpluses and buys our assets with them. They buy our treasuries and they shifted more toward buying our equities. To some extent, they buy our real estate, but our equities and our treasuries are kind of the main things they like to buy. And that gives America, that's really good for Wall Street. That's really good for DC. That's really good for tech. That's really good for, hegemony, like sanctioning any country you want, all those types of things. But the main cost of that whole system is deindustrialization, that your domestic lower margin manufacturing sector is so much weaker. And I think that basically the downsides have gotten to enough kind of pushback. Now we're starting to get more populist candidates that kind of question the structure of the system, or we get, the military pointing out how much their supply chains are compromised by decades of this kind of shift of physical capital, human capital. And so yeah, there are kind of a pendulum swing actions that could pull some of that back. They are generally inflationary, and I think the risk is that they take a lot longer than people think. You can't just flip a switch, bring all the manufacturing home. There's a lot of human capital, basically technicians, know-how that kind of, we invested everything into finance, not into building stuff, and that does take years of building and retraining. So it's a process.
It's also the whole supply chain. It just does not exist in America anymore. Like if you want to build something, good luck. So I don't know if reshoring, bringing back manufacturing is even in the cards. I mean, Tesla is doing something there. They managed to build things themselves, but for the most part, like you're saying, when the talent is not there, the disciplines, the engineering capacity to do basic construction of parts, fabrication, all of that is just missing. And I don't know if it can come back. That maybe it'd take decades.
I think it'd be at least a decade story, probably longer. The main advantages are that, for example, compared to Europe, America is more energy secure. So America has a secure energy situation, really good river system for and a obviously coast and harbors and stuff for transport. So there are some of that physical stuff, and the main thing that takes time to bring back is the currency has to kind of be meant for it. Then you got, like you said, you got to build up the human capital and you got to build up the physical infrastructure, things like ports, things like shipping, things like logistics centers. This is a decade minimum story. It's not a one-term thing.
That's something that feels like it's much needed in the U.S. though, especially the airports. Need an upgrade.
Yeah.
And this is like the repatriation of manufacturing is itself inherently inflationary, right? You think about, people talk about what would an iPhone cost if it was made in the US, and it's like, $20,000-$30,000. So everything is going to be more expensive because labor is more expensive. There's more unions. You don't have, like the situations with Foxconn in China with kind of these kind of exploitive labor practices. You don't get the benefit of that. And then, I wonder what that means for ESG and pollution as well, because a lot of that is that you're outsourcing a lot of your pollution into places like China, and a lot of that has to come back too. So that's interesting.
That's a huge factor that people like underestimate is the power generation you need. Even if you think of the future and think of automating all this, so let's say you've reduced the labor differential, you still have a power differential, and building that and operating that is something that, especially in kind of we have like a not in my backyard mindset, regulation wise and social wise. There's a lot of moving parts there to getting all those different variables back.
Yeah, but I think you also mentioned that the U.S. is energy secure. Maybe it's energy secure now, but I think moving forward, there has to be a massive growth in energy infrastructure. If you look at China, they're boosting coal consumption. They're building dozens of new nuclear plants. I don't see that on the horizon in the U.S., but I believe that's also a part of Trump's platform too. Like he realizes AI needs energy, so they're starting to shift in that direction where you need to build something and build the base for the future.
Yep, absolutely.
All right, shifting a little bit, but still sticking on the topic of inflation. Like, how do people protect if inflation is baked in the cake? We're going to get inflation no matter what. I guess that's a great pitch for buying Bitcoin. But how do people protect themselves from inflation? And Samson, how do you see people dealing with inflation around the world?
Well, I don't know. Most people aren't that worried about, like, it depends where you are. If you're in the developed world, Western world, then yes, you're dealing with inflation. But if you're in the developing world, and this goes to people, what we talked about earlier, people using Tether, right? They're not worried that much about inflation. They're worried about the inflation or hyperinflation of their currencies, but they're more worried about getting by day to day, and they're using the US dollar as that inflation hedge because it'll devalue or inflate much less than their native currencies. Yeah, it's the least ugly. But I think ultimately the only real inflation hedge is to move into Bitcoin. And I think that has to happen sooner rather than later. But we are seeing it, right? People are starting to accumulate Bitcoin a lot, either through the ETFs or buying directly. And that is correlated with the price increase we're seeing now. Also anecdotal data from OTC desks and everything that we're engaged with, we're seeing a lot of buying from maybe not billionaires and millionaires, but wealthy people are putting hundreds of thousands of dollars into Bitcoin as that hedge and as a savings mechanism. So yeah, we just need to get more people into Bitcoin, and they'll realize it and they'll understand it when they find that it costs $5 for an egg in the future.
Buy chickens, long chickens. So, we had Larry Fink making exactly this pitch, right? So never did I think that Larry Fink would become a Bitcoiner, but, it's funny how things work out. So he said recently in a Kramer interview that, Bitcoin is a safe haven asset. Do you think that he believes this? Or is he just talking his book? Because these ETFs have been massively successful, I think, by any metric. They're printing money on them. Do you think that he sees Bitcoin as a safe haven, as maybe part of the solution to some of the problems in the legacy system that we've pointed out, or is it just talking his book?
Lynn, or?
I mean,
Me.
my understanding
Here you go.
from BlackRock, because they have teams there, and they do
Yeah.
analysis on what they can put in portfolio. My understanding is that there are, teams there exploring the question, how does Bitcoin behave in risk off scenarios? And so, what one person says on TV, everyone
Yeah.
kind of talks the book all the time, but basically my understanding is
Yes.
there is serious analysis into the question of how does Bitcoin behave as a risk on or risk off asset in portfolios? Because if it does behave as a risk off asset,
Yeah.
there's different portfolio types you can put it into. When you're kind of measuring, say, the Sharpe ratio, the risk adjusted or volatility adjusted return potential of a portfolio, and there are professionals in multiple firms, I'm sure, including BlackRock, doing that analysis.
Yeah, I mean, that was one of the original pitches for Bitcoin is like if you take a 60-40 kind of portfolio and then you put like, X amount of Bitcoin in it, what does that do to your total return? So that's interesting that everything old
Yeah.
is new again.
Yeah, and they care. I mean,
Yeah.
so depending on what kind of portfolio manager you are, you care about the long term. For example, what does Bitcoin do to a portfolio over a 5-year period? But then also from a shorter term perspective, a number of portfolio managers care, how does Bitcoin behave within, say, a week of risk off conditions? Because they don't want their whole portfolio does worse during that time per se.
Yeah.
So
Yeah.
there's a time frame management question, and so. And it's funny because obviously risk off asset means different things to different people. For some people, the fact that you self custody your own asset, you don't care that much about volatility, that's one type of risk off asset. It's a bare asset that you own and is portable and is very hard to take from you. But from usually from traditional finance analysis, what they mean is volatility or risk of complete loss. And so they're looking at it and say, in a given week or two of a war breaks out or a banking failure happens or a
Yeah.
recession hits, does the asset go up or down? And that's often what they mean by risk off or safe haven.
Maybe rephrasing that question a little bit so it's not specific to Larry Fink. Do you see signs of change within legacy finance? Do you see people looking at Bitcoin as a way to kind of tweak the system, or do you see them kind of incorporating it into the system?
So over time, I mean, I think the majority of them see it as incorporating into the system. I think that the
Yeah.
starting point is a lot of them see it as an investable asset.
Yeah.
That's kind of the starting point. There are people that look out years or decades and at least have the question. There'll be a bank and they're looking at Bitcoin, or they're looking at Bitcoin Venture, and they're saying, we want to understand this asset in case something could disrupt us a couple decades down the line, right? So there are some people in positions of power and investing, and having an open mind to say, if email disrupted mail, could Bitcoin disrupt what we have now? But I think the majority are still looking at is basically, can we add this to client portfolios? What does it do to those portfolios? A lot of people they focus on career risk at first and foremost. So it's like, if I put this
Yes.
in a portfolio, if it does well, fine, but if it does poorly in one downturn, I might lose my job. So that's the problem.
Yeah, I had exactly that line. When in 2016, I was at Macquarie and I was pushing the idea of like an ETN or an ETF for Bitcoin. Got introduced to one of our senior fund structure guys, and he told me, I'm not putting my name next to a Bitcoin product. Had exactly that situation. Another thing I wanted to talk. Exactly right. Yeah, HFSP, right? Another thing I wanted to talk about is how emerging markets and developing markets become not developing markets, because there's not really a good path forward for that, I don't think. And the most recent examples I can think of are kind of like the Asian tigers and China, right? So like China, Taiwan, South Korea, Hong Kong, Singapore, I think are the most recent examples, which is not that recent. I mean, that's several decades ago. And I don't really understand what the path is. Like, what's the recommended path? It seems to be kind of like taking payday loans from the IMF, and there's just no way for them to get out. And I think what El Salvador is doing is something new in a way, but it's also similar to what the Asian tigers did, where it's investment in infrastructure, it's investment in education and technology, and a lot of it being government directed. What do you think the path is out of that, and what role does money play in that?
Well, so it's interesting. If you look at the past 50 years or so, there's been hardly any developing countries that became developed. Like you said,
Yeah.
there's a handful in Asia that did it, It's a very small sample that managed to do it. And you have kind of a problem there where these countries don't have capital, so they borrow in currencies that others can print, but that they can't print, and that others can harden with higher interest rates or quantitative tightening or cut interest rates and do quantitative easing. So they borrow in something that doesn't match their assets and cash flows, and it kind of gets rug pulled from them with cycles of tightening and things like that. And that then makes it some cases even harder to borrow in their own currency, because any lender is looking at their external debt now, and they're looking at that kind of that volatility issue. And so it's a very difficult trap to navigate, basically going around that system. I mean, Alex Gladstein's been very critical of the IMF and the current kind of the solution to everything worldwide is, well, you have a debt problem, let's fix it with more debt. It's like restructure your debt
Exactly.
and do even
Yeah.
more debt. But I do think that countries that go around that system make a lot of sense. Accessing capital markets, with tokenized assets on the Liquid network or elsewhere. There's a bunch of different methods using technology where possible, and basically not just kind of going through that playbook and assuming that what didn't work 14 times in a row over, you look at a country, they'll have 14 restructurings, and
Yeah.
they're in more debt than they ever were. And it's like there are, I think, bold moves to take to go around that system and do what so far a very small number of countries have been able to do over the past 50 years.
Yeah,
I-
just
I-
going back a
Oh, go
bit
ahead,
to
Evan.
the. I want to comment on the Larry Fink thing. So, I don't think it really matters if he is a Bitcoiner or not.
Of
What
course.
matters is that he's shifting the Overton window. So, the first thing that BlackRock did that I appreciate is that they shifted it that Bitcoin is ESG compliant, because they are the largest ESG investor, and there's been a ton of FUD around Bitcoin boiling the oceans and whatnot. So they kind of nixed that, and you can see that in the media. Like the media stopped FUDding Bitcoin based on environmental grounds now, or maybe a little bit here and there, but very few and far between. And if Larry Fink is saying this is a safe haven or it's a future reserve asset, I think it's a good thing. And it doesn't really matter what his motivation is, but we know for a fact that his financial incentives are aligned with Bitcoin, because their ETF, their Bitcoin ETF, is the fastest growing ETF ever. It's got the most volume traded of all of them. And likely the fees of that ETF are going to be massively significant for BlackRock as a firm for the next several hundred years. So he's in it, whether he likes it or not.
Yeah.
And he's saying the right thing. So I don't think it really matters at that point. Your other question about the way that countries can grow, I think for the Asian tigers, like two of them focused on building up financial industry, right? Singapore, Hong Kong. And the other two focus more on manufacturing industry, Korea and Taiwan. So I think the way that countries have to grow and not be burdened with debt is to find industries that they can specialize in and grow. So El Salvador seems to be trying to go the route of Singapore and Hong Kong, right? Financialization.
Yeah.
I think this is a key thing, that they passed the digital securities law that allows for them to support the growth of this digital securities industry. And I think it's still yet to come, but things like the blockchain mining node being so successful, it shows that that is the right way. And if they, fingers crossed, do the Bitcoin bonds, I think that will show that it is the right path forward to create this environment that can foster capital formation and capital creation. But if you go back and look at the four Asian tigers, the key thing is that their economies were very much open to investment from everywhere. And I think the stagnation that we see currently is when money is degraded and is no longer money. So you have to monitor and track funds and see where everything came from, and there's a line for good money and bad
controls,
money. Yeah, and capital controls. That's a big part of it now. And with Hong Kong reverting back to China, like everyone I've talked to in Hong Kong is saying it's much tighter than before. It's hard to get money and see that capital formation and growth. So I think it's sort of a trick, I guess. I don't know who is pushing it, but there are supranational organizations pushing this. And by doing so, and the countries accepting it, they're actually limiting their own economic growth.
Yeah, it's interesting. I mean, circling back to the kind of the IMF thing too, I've had a bit of interaction with some of these countries that have been involved with that. And Samson, you probably had more. And one thing that strikes me is that there's not a lot of institutional knowledge in some of these emerging market countries. It's like one guy who went to, an Ivy League school in the U.S. and then came back to help out the Ministry of Finance. So a lot of it almost strikes me as predatory because people don't seem to really understand the details of it, and that's part of the reason. And there's such a brain drain. Like we talk about a brain drain in Canada. It's so much more pronounced in developing markets where everybody who has talent and the capability and capital, they leave. And then, you're kind of running with the B team. And I think it makes it difficult and kind of predatory.
Yeah, well, I think it also has to do with the fact that there is this pile of easy money to get, and you kind of are incentivized to play ball. Otherwise, you might lose that easy money. Now, if you're a leader that is more forward-thinking, long-term thinking, then I think it's not as attractive. But for anyone looking for short-term gains, a quick win on their bingo card, like, I got some money to build something, then you kind of have to play by those rules set by the IMF or the World Bank. And that's what gets you into trouble.
Yeah, definitely. Yeah, what you mentioned about focusing on an industry, that's really interesting because that's kind of our pitch, obviously, is that it's difficult for these small to mid-sized economies to compete with legacy capital markets and financial centers head on, but there's an opportunity to go asymmetric and to embrace this technology and kind of work around them and provide an alternative. And, like you said, it's a grind. It's not going to happen overnight. But I think, there is a real opportunity for that. And I think the regulators that we're engaged with, they appreciate it. And that's part of the reason why they're, number one, financial services aren't as big a part of GDP. So you don't get that pushback from these incumbents. And that's the opportunity. But yeah, no, I think they get that. And like you said, Larry Fink and his comments, they support all of that because he's had a lot of positive comments on tokenization. Although I think his motivation is more about, firing his back office and improving margins more than about your own personal freedom, but it's all supportive. All right, shifting gears, maybe ask you quickly, Samson, you touched on Hong Kong. What about China? So Hong Kong passed these Bitcoin ETFs, which are actually really interesting because you can do in-kind subscriptions and redemptions. And obviously, China has a history of banning and unbanning Bitcoin. And I know that, you were at BTC China previously, which was, the biggest exchange in the world at the time. And actually, it was Bobby who gave me that hat, the Make Bitcoin Great Again hat. So I got that from Bobby Lee. What do you think's going on with China? Is there a chance that we see a rewarming to Bitcoin?
Yeah, I think so. The Hong Kong ETFs definitely are a sign. I don't think they would have been greenlit without tacit approval from Beijing. So I think there's sort of a implicit approval of Bitcoin, and we'll see how it develops. Can mainland investors, like ordinary mainland investors, invest in those ETFs? There are a few groups working on making that a reality. So if that does come to pass, that'll change that landscape. But I think there's a lot of talk of Web3. And I think for us, we're not really fans of Web3, but Web3 is sort of a way that they can embrace, Bitcoin and everything else without backtracking on the anti-Bitcoin stance of days old and, shutting everything down. So they can say it's different. It's like, it's just the web. It's not about money and digital assets and bearer assets anymore. But I think there has to be a shift. I was talking to a lot of people in Asia recently, and the sentiment is that the economy in China is not well right now. Real estate is in a crunch. There's population decline, and there's just no liquidity.
Massive youth unemployment.
Yeah. So how do you get out of that? You can't really grow your way out of that situation, especially with the population decline, right? I mean, you can try to bet on new technologies like AI and whatnot to kind of bridge that gap, robotics, things like Japan are trying to do. But the crisis is so deep, and it's so intertwined with real estate and all of the housing that's been built up over the past few decades that's going to be empty. There is no real way out of this solution other than to adopt Bitcoin. And I think eventually it will come to pass that they have to do something and pivot to Bitcoin. And we're seeing ICBC, the biggest bank in China, talk about Bitcoin now, whereas that would never have happened before. And like him or not, Trump's murmurings about Bitcoin do reverberate massively throughout the geopolitical spectrum because he is a former president and likely the next president. So him talking about strategic Bitcoin reserves, whether he does it or not, has massive geopolitical implications for countries that want to keep up and stay competitive with the US.
It's interesting. I noticed this in the last cycle, when you had countries or cities like Miami talking about Bitcoin, you had Texas talking about Bitcoin, you had Hong Kong talking about opening up to Web3 and Bitcoin. It's like Bitcoin is the growth driver of last resort. It's like when you're really struggling and you need a Hail Mary, they turn to Bitcoin. So yeah, that's interesting.
I think a trap a lot of them fall into, a lot of finance people fall into, is assuming that the multi-decade phase of like more and more financialization is going to continue. So they think like, how can we monetize everything and make every single thing tradable, even certain things that don't make sense to be tradable or put on the blockchain or have their own free floating, price token. Whereas, a lot of people in the Bitcoin space, myself included, view sound money in some ways as a definancialization tool, that we've been in a situation where our money's been so weak that we have to monetize other things that don't necessarily need to be money. They can just be utility, like real estate, for example, in most cases. So by having a really good sound money, you actually think in many cases of definancializing terms. Now, it's not black or white, because at the same time, you can realize that there are certain assets that can certainly be better off by having better rails and more cross-border rails and all that. It doesn't mean that there's no spot for that. But I think that mindset that, a city gets into like Web3 and then thinks they have to have their own token, and then they go down that hole instead of things like embracing Bitcoin, embracing, rational securitization and things like that. There's a very wide path that leads to problems, and a fairly narrow path that usually takes a longer period, I think, education and learning to get to that path.
Yeah, but the other thing I think is China will eventually embrace Bitcoin, because there is a history of gold, right, purchasing from the central banks in China, and gold has had a very long, couple thousand years history in China as well. And this circles back to the point that you guys were talking about early on in our chat, but like, why are people not embracing tokenized gold, like Tether Gold and everything like that? I think it has to do with understanding of money. Like, most people are like, the biggest use of Tether, I think, is in the developing world, right? They're not really thinking about saving, and gold is more of a savings tech, and like, old savings tech, but they're not thinking along those same wavelengths. They're thinking more short term, purchasing power preservation. So, China, on the other hand, does have that experience with gold, and I still like to call Bitcoin digital gold, because it's the easiest way for normies to understand Bitcoin, that understand sound money and things like gold. So I believe it is inevitable that China will embrace Bitcoin in a big way.
How does that match up with their capital controls, though? I mean, it feels like they has to something structurally has to change, because,
well, there has to be a reckoning eventually, right? You have to reconcile the fact that money is now information, and you can't really control information. You can try, but you will fail. So, I mean, this applies to every country with capital controls. Korea has capital controls as well. But
everywhere
as long as Bitcoin exists, then capital controls do not exist. So it's just a matter of every institution and government coming to that realization and saying, well, this is just like, that meme where there's like a park and a path, and they have a sign to stop you from like riding your bike there, and then the bike trail goes around it. It's that, right? 'Cause eventually someone's got to give up and yield. And I think countries that adopted the Bitcoin standard, like El Salvador and others, they're going to start the revolution and accept that money is information, information is money, and you can't really stop it now.
Yeah, we're coming up on time, but I did want to get, Lynn, your opinion, and also talk to Samson about the Blockstream mining node. On it strikes me so broken money. I guess part of this is technology, and the technology behind money is outdated. And I think for capital markets, the technology behind capital markets is kind of outdated as well. So things like central depositories and how trade settled. And I feel almost like you have a system where you've got like a Tesla, and then you've got a horse and carriage. And, Bitfinex Securities, we're kind of like, we've got the better technology. We're like the Tesla, but it's the horse and carriage system that's bigger and sets the rules. And I think there's an opportunity here to kind of upgrade the technology. But so I think that lines up with the points that you're making in broken money. But your point on definancialization is maybe slightly contrary to some of the kind of arguments that people make in the security token space, where they're like, we want to provide liquidity to everything, right? To real estate. I think some of that is maybe not achievable or realistic, but just kind of wanted to get your thoughts on security tokenization generally.
Yeah, so I do think that tokenizing things is useful in the sense that allows things to go across borders, allows small markets to access big pools of capital. It can be in some ways
Yeah.
more efficient than the current system. I think that there's two kind of like streams passing each other there. So on one hand, there's the tokenize everything crowd.
Yeah.
But there's some things that just inherently don't make a ton of sense tokenized because they're still central at the end of the day. If you tokenize your house and then it gets
Yeah.
hacked and it ends up in the hands of foreign hackers, they don't really own your house. There's still the local authority that says, no, we're going to void that and you still own the house. It's still at the end of the day a ledger. But you obviously want credible ledgers that can work between multiple counterparties that can go across borders. So I think that on one hand, I am not bullish on the idea of tokenizing everything or everything's going to have their own money or things like that. But that
Yeah.
doesn't mean that there's not a rational need to improve some of the trading rails that happen and that make these things more efficient. So I've not been bearish on stable coins. I've not been bearish on stable gold coins. I do think that various securities on places like the Liquid network make sense. And that's different than the idea of kind of tokenizing everything, having like a Miami coin, having like my own Lin coin.
Yeah.
That's the tokenization theme that I push back on.
Yeah, no, I totally agree. I think it has to go ahead, Samson.
Can I get in on the pre-sale of Lincoin?
There will never be a Lin coin.
I think it kind of has to fit into one of those traditional buckets of like, is it equity, debt, is it a fund, a commodity, something like that. Just on the hackable thing of hacking your house, maybe Samson, you can talk about this, but I think that's one of the benefits of doing tokenization on Liquid and with this transfer restricted asset functionality is that you create a whitelist, and if somebody, I think it's basically unhackable, right? Because you've got basically a registry, and you can, if somebody loses access to it, you can reassign the tokens to people, and it just becomes where even a custodian is not necessarily because you have that registry and you know who owns everything. So things can't really get stolen.
Well, I mean, someone can lose their tokens, right? So for EXO, we had to reissue because some people just lost their wallet. They forgot they deleted Blockstream Green and it's gone. So yeah, I think you do have to restore it sometimes, but the benefit of tradability, I think, it can still warrant tokenization. So I think Lin's point about your house being stolen is like, obviously they don't own your house, right? Like you can still reclaim it, but it goes for any security token. There is still, a legal contract there, and you can go back to it and fix it in post. But I think the benefit of tokenization is that you just gain benefits. You have 24/7 trading. You have a semi-bearer asset. It is not fully bearer in the sense that the underlying is not yours, but then for most securities, you can't really. It's just a claim still on either the equity investment or the project or whatever. So I think it's still a marginal improvement on that. And I think things like the Blockstream mining note and I think Bitcoin bonds will show that these things are very viable because you can lower the threshold for onboarding new users. It's much simpler a process. You simplify the trading, the peer-to-peer trading aspect of it. It's atomic. And the payouts for things like the dividends or coupons can be done at scale at a much lower threshold. So I think for the Bitcoin bonds, it was like $100 investment, and you could technically pay out a few dollars per year for the coupon, and it still wouldn't break the system, right? So I think there are a number of reasons why tokenized securities do make sense, but the challenge is just getting that one big leader project out there that shows people, because right now security tokens are in a bit of a weird spot. It's much lower barrier of entry to do an ICO and rug pull your investors than it is to go through the legal paperwork, structure everything, and issue it. And then at the same time, you have pure crypto stuff that just is like meme coins and everything like that. So you're putting in a lot of effort to try to do a legitimate project, and the reward spectrum, I guess, is much less than launching a meme coin out of your basement and making 1,000x, at least for the issuer. So I think we just need some big group to do it. Maybe it's BlackRock, who knows? But there are other big financial institutions that are trying to push it. But we just need some big project out there that shows the world that this is a viable method for capital formation and generation.
And I think
Yeah,
that's one of the paths that countries have today of escaping that developing country trap is that by embracing that kind of narrow path, where you're making use of new technology, but you're not falling for false claims of the technology. You're not falling into the meme coin trap or the tokenize everything trap, but you're saying, hey, we have better tech rails for
yes.
matching real world assets with claims of those assets and the logistics of those assets. And that they actually care about the long-term viability of the assets that they're issuing. I think that's a path of capital accumulation, and that's one of the basically the cheat codes or the basically the narrow path of kind of going down that to actually go out of this kind of system that kind of keeps accumulating more and more dollar debt throughout the world.
Yeah, that's one of the really interesting things about El Salvador is that they've almost uniquely figured out what are the accretive parts of this like digital asset industry. Like they figured out that it's not dog with hat coin, and it's not a thousand other like layer ones. It's Bitcoin and then developing the capital markets on top of that. And I think really, I don't think many makers or regulators have figured that out. That innovative part for them, it's a lot of Web3 kind of stuff, and they don't really know what that is, but it's a good buzzword. So I think that's one of the exciting things about El Salvador is they figured it out, the cheat code.
Well, El Salvador had some really good advisors back in the day.
So good presentations too.
Yeah.
All right. Well, I think we should wrap it up. I mean, we could talk much longer, and this has been a really good conversation, and I appreciate your time. Maybe just to wrap it up quickly, Lynn, what do you think are the major kind of trends and flashpoints that we should be paying attention to over the next, maybe 6 or 12 months?
So I think the U.S. election's a big one, especially for this industry. I think it's a big one for price. It's a big one for actions that could be considered uncommon, like the U.S. engaging in some sort of major currency intervention or novel reserve accumulation, that kind of thing. That's obviously a big Boolean outcome. Then there's things like so far I've generally seen that global liquidity indicators tend to be very correlated with Bitcoin price. It's one of the closest correlates that I've seen. It's kind of a proxy for incoming demand. Or if you picture the dollar and Bitcoin being a trading pair, we all know about Bitcoin's halvings and how it goes through hardness over time. The dollar goes through periods of hardness or softness, and so basically liquidity is kind of a measure of that. So you're kind of measuring the hardness or the softness of the thing that Bitcoin's trading against. And so I'm looking kind of toward those liquidity actions, basically fiscal decisions, Fed decisions, especially as it relates to their balance sheet potentially late next year. Those are the major things I'm watching kind of post-election.
Great. Samson, what are you watching over like maybe the next 12 months or so?
Pretty much the same thing. I think the U.S. election is going to be pivotal, and we have to see what Trump is going to do. But knowing Trump, he always does it in a big way. So I would expect a big announcement, and temper that with what actually is happening or happens in the future. But something will happen, definitely. And I would say this is going to pave the way for more countries to follow, because everyone seems to want to follow the U.S., even though they could front run the U.S. right now. But another indicator is debt, U.S. debt specifically. It's on the increase. The interest to service the debt is also on the upswing. So I think everything is pointing towards Bitcoin number go up massively. And I think Lynn mentioned it to the liquidity is an indicator to watch, but global liquidity is on the uprise. So there is another big bullish factor.
So are you still confident in your price target, Samson?
Definitely.
All right.
I am not uncertain.
Beautiful. All right. Well, thank you, Samson and Lynn, for your time. I very much appreciate it. It was a great conversation. Everyone watching, don't forget to follow at Bitfinex Securities and at Blockstream on X or Twitter for updates on future episodes. And again, thank you for your time today.
Thank you.
Thanks, Jesse.